Hello everyone and welcome back to my channel. My name is Richest and in today's video I want to share with you 5 tips of my favorite investor of all time, Warren Buffett, or the Oracle of Omaha. And if you don't know Warren Buffett yet, I strongly advise you to read into him because he's one of the best investors out there. He started basically with nothing when he was younger and now he's one of the richest persons in the world, and they estimate his total net worth over $100 billion. Let's dive into 5 of his investment tips and let's see if we can learn something from that. Warren Buffett owns a company called Berkshire Hathaway. And from origin, it's a textile company, but he turned it into one of the biggest investment companies in the world. And right now, they own many different companies or own big shares of companies like Apple, Coca-Cola, he owns Geico, an insurance company, and many others. And besides all their holdings in those companies, he also has almost $150 billion in cash. So if you would buy Berkshire Hathaway right now, the full company, you would get $150 billion in cash or cash equivalents right now. And that's a nice bridge to go to the first tip of Warren Buffett, and that is cash is king. What does that mean? Well, cash is king basically means that if you have cash, you are the king. And Berkshire maybe takes this a little bit too far because cash is not a really good investment, especially if you consider inflation, which is about 2 or 3% per year. And let's say inflation is 3%. If you have 150 billion in cash, that means you lose 4.5 billion per year, just because of inflation. So why does one of the best investors in the world keep such a big amount of cash? Warren Buffett is a value investor and he really barely makes investments. He really thinks it over very well. And he once said, imagine if you can only do 20 trades in your lifetime. And Warren Buffett had a nice analogy to describe this, and I will show you guys what the Oracle had to say about it himself.
You would be better off if when you got out of school here, you got a punch card with 20 punches on it. And every financial decision you made, you used up a punch. You'd get very rich because you'd think through very hard each one. I mean, you went to a cocktail party and somebody talked about a company, you didn't even understand what they did or couldn't pronounce the name, but they'd made some money last week and another one like it. You wouldn't buy it if you only had 20 punches on that card. There's a temptation to dabble, if, particularly during bull markets. In stocks, it's so easy, you know. It's easier now than ever because you can do it online. You know, just you click it in and maybe it goes up a point and you get excited about that and you buy another one the next day and so on. You can't make any money over time doing that. But if you had a punch card with only 20 punches, you weren't going to get another one the rest of your life, you would think a long time before every investment decision. And you would make good ones and you'd make big ones. And you probably wouldn't even use all 20 punches in your lifetime, but you wouldn't need to.
Another analogy he had is like with baseball, 3 strikes and you're out. So at some point you have to swing. But with investing, you don't have to swing. You can just wait for the right moment, the right ball, and when you know that you're gonna hit it, then you're gonna swing. But well, let's go back to cash is king. So he keeps a whole lot of money in cash to dive into opportunities when they arise. The stock market has been on a rally for the last year. Ever since the stocks went down a lot, they are back to normal or even higher than they were before the pandemic hit. So right now, a lot of stocks are high value and the opportunity for short-term growth is kind of low. So when there will be a big market crash and a lot of stocks will go down a lot, then he probably will pour in a lot of his money into the stock market and probably will make a big profit. And this is what he also did after the financial crisis in 2008-2009. He was the one who had a lot of money in the bank in cash or cash equivalents, and he used that money to borrow to companies, to buy a lot of companies, and in the end he ended up making a big profit. And that brings us to tip number 2 of Warren Buffett. And this is a well-known phrase: be greedy when others are fearful, be fearful when others are greedy. And this is one of my favorite quotes of Warren Buffett. And it always reminds me when the stock market takes a hit or when stocks go down a lot, that is all right and that is the time to buy extra. So what does it mean? Be fearful when others are greedy, be greedy when others are fearful. What he basically is saying is be fearful when others are greedy. So that basically means like, okay, if everyone is talking about investing, everybody is getting greedy. They think, oh, we can make a lot of profit, everybody is investing. That is a sign to be fearful. So that means to be scared that evaluations are probably way too high. There's way too much hype in the stock prices, and it probably will go down a lot. A nice example is maybe Bitcoin. If you look back at 2017, everybody was talking about it. Everywhere you went, how is it going with Bitcoin? Everybody was investing in it. And that was a reason for him to be fearful of that. And the opposite is also true. If people are scared, if people are fearful of investing, that is the moment to start investing. Because if everybody is scared, everybody is selling their stocks, the share price will go down. And you can make the most profit if you buy low. So that's also something he really profited from after the financial crisis in 2008, 2009. Everybody was fearful, nobody believed in the system anymore, nobody believed in the stocks. Everybody was selling their stocks. And that was the moment to buy, and that's what he ultimately did, and he made a big profit off that. If stocks are going down, if the market is going down, don't think of it as a bad sign, think of it as a buying opportunity. And when everybody is investing and stocks only go up and up, try to be a little careful and maybe a little fearful, because probably they are overvalued and there's a big risk that the prices will go down and you will end up losing money. Tip number 3. Dividends are your friend. So if you guys are following me for a little now, you know that I love dividend investing, and so does Warren Buffett. He loves it. And he loves especially investing in dividend companies that are called dividend aristocrats. And to be called a dividend aristocrat, you have to be increasing or maintaining your dividend payouts for at least 25 years. So that means that in 25 consecutive years you have been paying dividends and also increasing the dividend payment or at least maintaining it. So like always, dividend payments are never guaranteed, but with these dividend aristocrats you can really safely say that they probably will pay their dividends because they have been doing it for at least 25 years in a row. And one of Buffett's favorite stocks is the Coca-Cola company. Berkshire Hathaway owns 400 million shares of Coca-Cola, crazy amount, that is valuated at more than $20 billion today. And he announced that the dividend payments alone from the Coca-Cola company are higher than what he originally paid for those 400 million shares. Even if the stock price will go to zero, he will still have made a profit by investing in Coca-Cola. And right now they trade for around $50–$55 per share. So that shows you the power of investing in dividend stocks. Number 4 is always buy undervalued stocks. And this sounds really simple. Why would you buy overvalued stocks? But this is something Buffett really lives by. He really tries to look at the intrinsic value of a company. So not just looking at the potential, but he looks at what is happening today. So for example, what is the cash flow, what is the operating income, what is the profit margin, and he has like his own formula to calculate the intrinsic value of a company, and then he looks like how much is the company worth, and if the company is worth less than he thinks the intrinsic value is, then he will buy big time on those stocks. If he thinks the company is overvalued, he will never buy it. And he always tries to buy companies that also have a competitive advantage or something that's not easy to replicate. So for example, with Apple or Coca-Cola, those are such strong brands that probably will continue for a long time. And that's what he really likes. So he doesn't just buy a company, he does a lot of research And after he did a lot of research and found those companies that he wants to invest in, he waits for the right time, the right price, and when he thinks it's undervalued, then he strikes and buys the companies. And the last tip of today, number 5, is to buy and hold. That's what I said in the previous tip. He researches companies that he thinks will do well in the long term, so he can hold his positions forever in the most ideal situation. Of course, he is always closely monitoring how are the companies doing, did some factors change, and did the company lose their competitive advantage, or is it way too overvalued? Then he will trim back on those positions. But in general, he buys a company and he holds it and maybe even adds to that position. So for example, Coca-Cola he owns for almost 40 years, I believe, or even longer, and he never sold any shares of Coca-Cola. And that's where you will gain the most profit, if you can buy and hold over a long term, because in the short term stocks can go down a lot, but over time in general you see that stock prices tend to go up, and the longer you keep the stocks with you, the more profit you will make, and then you will have interest on interest, and then you make a lot of profit by investing. So he is really patient. He does a lot of research before he buys into any company. He waits for the right price, and then when he buys big, and he keeps those shares in his portfolio for as long as he possibly can, or when something fundamentally changes and he thinks he needs to get rid of that stock. So yeah guys, those were the 5 tips of my favorite investor of all time, Warren Buffett. And of course he has a lot of more tips. The guy is 90 years old. He is one of the best investors, one of the richest men in the world. And another thing I really like about him is that he lives so frugally. Like, he is one of the richest people in the world, but he drives a car until it really isn't safe anymore, and only then he buys a new car. And it's not a Ferrari or something, no, he drives a Ford because it doesn't depreciate so fast, and he doesn't even have to worry about these things, but he just likes to do that. He also told a story that if he finds a dollar on the ground, he will pick it up, because to him every dollar counts. Yeah, he's just a big inspiration for me. That being said, thanks for watching. If you liked the video, please don't forget to smash that like button, and if you haven't already, please don't forget to subscribe. Thank you guys for watching. I hope I see you in the next one, and like always, have a great day.